Every month, millions of people working abroad send money home, sometimes half their paycheck, just to help their families eat, study, or build a better life. A few years ago, sending $100 home from the US to Mexico or India or the Philippines could cost you $10 in fees and might take days. Today, one company is quietly changing that, and it's growing faster than PayPal in its early years. This fintech's active customers grew 24% last quarter, crossing 8 million worldwide. Its revenues jumped over 30%, and for the first time ever, it is cash flow positive. The stock is Remitly, a money transfer platform you might have heard of, especially if you've ever transferred money overseas. But is it the next big compounding story, or just another overhyped fintech fad? Let's break down the business model, the growth math, and whether Remitly could be the next big winner. Before we begin, I want to remind my viewers that this is not financial advice. I'm merely sharing my perspective on Remitly and why I am bullish on this stock. Please do your own research before investing. Moreover, I just want to take a moment to say thank you to everyone who's watched, liked, commented, or subscribed so far. When I started this channel, the goal was simple: to share thoughtful, well researched investing ideas. Now, each video takes time because I actually study these businesses in depth and more often than not, invest in them myself. Right now, we are around 410 subscribers, and I'm genuinely grateful for each and every single one of you. My goal is to reach 2,500 subscribers by the end of the year because your support keeps me motivated to keep doing the deep dive, fundamental first analysis that takes hours to prepare. So if you enjoy the content, please consider subscribing. It's completely free, and if it ever stops being useful, you're always free to unsubscribe. But if you stay, you'll be a part of a small but growing community of people who actually care about investing thoughtfully based on fundamentals. Thank you for being here, and let's keep learning, compounding, and growing together. With that, let's begin. Let's talk about the business model for Remitly. Now, Remitly started with a very simple idea: to make cross border remittances faster, cheaper, and digital first. Every year, migrant workers send over $600 billion to their families. But until recently, most of that happened through slow, expensive brick and mortar networks. Think Western Union or MoneyGram. Remitly flipped that model on its head. Instead of agents and cash counters, it built a fully digital platform where users can send money from their phone directly to the bank account or a mobile wallet, or even a cash pickup on the other side. No branches, no papers, and crucially, a fraction of the cost. So, what does Remitly's business model look like underneath? At the core, it has three key revenue engines. One of Remitly's revenues comes from transaction fees. That's a percentage of the flat fee customers pay to send money. Now, this can vary between 1 to 3% depending on the corridor. And when I say corridor, that means, sending money from US to India or from the UK to the Philippines. So that exactly is a corridor. Now, what's interesting is that Remitly's business scales beautifully here. The more people use the platform and send larger volumes, the more Remitly earns without having to spend a lot more to serve them. And that's why you'll see that the gross margins are really high, around 58 to 60%, which is exceptional for a company moving real money across borders. High gross margins usually mean that the company has stronger pricing power or a scalable tech model. In Remitly's case, it's both. When users send money internationally, Remitly takes a small spread on the exchange rate, the difference between what it pays out and what it collects. Now, Remitly keeps this very transparent. Customers always see the rate up front, but the spread still contributes a meaningful chunk of its revenues. This foreign exchange component adds resilience. So even if the transaction volumes slow, the spread revenue helps cushion the margins. The company's newer focus is on expanding its financial ecosystem. Things like mobile banking, debit cards, and credit services for immigrants. Through its passbook offering, and partnerships with global banks. It's building long-term relationships with users, moving from send money once a month to manage your money every day. Now, this is where the story gets interesting. Remitly's customer base, which is over 8 million active users as of last quarter, isn't just growing 24% year over year, it's also becoming more engaged. That means higher retention, more frequent usage, and eventually higher lifetime value per customer. Remitly's model is elegant because it's built on volume plus technology leverage. So, unlike traditional money transfer players, its costs don't scale linearly with transactions. Once the tech and the compliance infrastructure is in place, every new customer adds revenue at a higher incremental margin. And that's why, even though Remitly is still early in its profitability journey, its adjusted EBITDA margins have been steadily improving, now hovering around 10 to 12%, up sharply from losses a few years ago. And its free cash flow margins recently turned positive. Now, here are some key insights from the recent quarterly results. In the most recent quarter, that is Q2 of 2025, Remitly's active customer base jumped 24% year over year, reaching about 8.5 million users. That's nearly 1.6 million new people using Remitly compared to a year ago. What's even more impressive, most of that growth is organic. People are joining because the platform works. It's faster, cheaper, and our word of mouth is doing the marketing for them. Send volume and revenue, if you look at that, then those customers aren't just signing up, they're sending more money than ever. In Q2 alone, users sent around $18.5 billion. That is up roughly 40% year over year. Now, adjusted EBITDA and margins is where the financials get really interesting. In Q2, Remitly reported about 64 million in adjusted EBITDA, with margins around 16%. A few years ago, this company was burning cash. Today, it's running a leaner, more profitable engine. And that 16% margin means it's not just scaling, but it is doing so efficiently. So far, so good. Now let's talk about the risks. The first risk, and that is the most important one as well, is regulatory compliance. Now, Remitly operates in over 170 countries, moving billions of dollars across borders. That means it's under the microscope of hundreds of regulators, from anti-money laundering to data privacy and consumer protection rules. Every region has its own licensing requirements and compliance standards. And even a small policy shift can increase costs or slow down growth. So far, Remitly has managed this well, but as it expands, staying compliant while scaling fast is going to be one of its biggest ongoing challenges. But at the same time, it also provides Remitly with a really big moat. Another major risk is stablecoin and crypto disruption. Imagine a future where people can send money across borders instantly using blockchain-based systems, bypassing traditional remittance networks altogether. Now, if stablecoins like USDC or future government-backed digital currencies become mainstream, they could dramatically reduce transaction costs and make money transfers nearly free. Now, the good news is that this shift will take time. Governments are still figuring out regulation, and trust in crypto isn't universal yet. But the risk is real. That being said, Remitly is already working on a stablecoin based system. The third is political and immigration risks. Remitly's business depends heavily on the global movement of people, especially migrant workers sending money home. So, immigration policies in countries like the US, the UK, and across Europe can directly impact Remitly's user base. So, the current tightening of work visa or the H-1B program in the US could slow the influx of new immigrants, and that would reduce transaction growth. On the other hand, policies supporting immigration or refugee resettlement tend to have an opposite effect. So, in short, political winds can shift fast, and Remitly's growth is partially tied to those shifts. Now, let's take a look at the valuation. What could Remitly be worth? Remitly has been growing consistently, and analysts expect that momentum to continue. By FY26, consensus estimates suggest revenues could hit about $2 billion. Now, of course, Remitly has already turned free cash flow positive, which means that it has crossed that critical point from growth at all costs to actually generating real cash. If you look at the gross margins, that's around 60%. That tells us something important. This business has plenty of room to expand profitability as it scales. So it's not a stretch to assume that over the next couple of years, free cash flow margins could reach around 25%. In fact, if you take a look at Remitly's recent results, it has already crossed 25% in terms of free cash flow margins in the past quarters. So let's run the math based on about 25% free cash flow margins. If Remitly does that $2 billion in revenues in FY26 and converts about 25% of that to free cash flow, that's roughly 500 million in annual free cash flow. Now, what multiples do we apply? For a company growing at around 30%, which Remitly is, with strong unit economics and a huge addressable market, a 30 times free cash flow multiple is very reasonable, and it's not overly aggressive. In fact, you'll see that a company such as Palantir, which is also growing north of 30%, is trading at 200 times free cash flow multiple. So for Remitly, 30 times free cash flow multiple sounds reasonable. And that would value Remitly at around a market cap close to $15 billion. Considering where the stock trades today, that's roughly a 5x upside potential over the next couple of years if management continues executing and the growth story holds up. So here's the bottom line. Remitly isn't your typical flashy tech stock. It's a company quietly building a real moat in one of the most essential financial services in the world, moving money. It's already growing fast. It's turned free cash flow positive, and it's sitting in a market that's still massively underpenetrated. Of course, there are risks, regulations, competition, even political headwinds. But if management keeps executing and margins keep improving, this could be one of those under the radar compounders that surprises everyone in a couple of years. If you found this breakdown helpful, don't forget to hit that like button. It really helps push this video to more investors. Also, check out my recent videos on Okta, the Trade Desk, and ASML. Each one dives deep into a different type of growth story and what we can learn as investors. Until next time, stay data driven.